If you thought the real estate market couldn't get any crazier, well, buckle up. Welcome to The Explainer. Today we are diving deep into the massive new interventions hitting the housing market, and more importantly, what they actually mean for your wallet. We're entering what's being called the Great Housing Reset, and between whispers of massive government capital injections and wildly shifting mortgage rates, the next phase of this market is absolutely going to catch a lot of people off guard. Our goal today is to look at the hard data, strip away all the noise, and figure out exactly where home prices are heading.
Here is our roadmap for today. First, we'll look at the $200 billion plan. Second, the root cause of all this, housing supply. Third, we'll break down the affordability crisis. Fourth, we'll answer the big question, will home prices actually drop? And finally, the new rules of real estate. Let's get right into it. Starting off with part one, the $200 billion housing plan and how capital is being injected into the market. So, we have to start with this massive headline. The incoming Trump administration has proposed injecting a staggering $200 billion into the market. The goal here? To drive down mortgage rates and basically make buying a home a lot more affordable for the average person by shrinking those monthly payments. But how does this actually work? Well, on an institutional level, when you get a home loan, your bank doesn't usually just hold on to it. Nope, they bundle it up with thousands of other loans into this massive package called a mortgage-backed security. These are then typically sold off to hedge funds or pensions that are just looking for a really safe return. Now imagine a buyer suddenly stepping in with $200 billion ready to buy up these securities. The market reacts instantly. It's basic supply and demand. That high demand pushes the prices of these securities higher, which ironically drives their yields lower, and that ultimately drops mortgage rates for buyers by up to 0.5 percentage point. Now 0.5% might sound kind of small, right? But here is the crazy part. Dropping the rate by just 0.5% boosts your true purchasing power by 6% for the exact same monthly payment. Because of this anticipation, we've already seen 30-year mortgage rates drop back down into the 5.99% range. I mean, we literally haven't seen lows like that since early 2023. But hold on a second, because it is absolutely crucial to put this into perspective. This is just a one-off, short-term intervention in an $11 trillion ocean of mortgage-backed securities. To give you a sense of scale, the Federal Reserve already holds about $2 trillion of these things. So this $200 billion injection, it's really only representing roughly 2% of what the Fed currently holds, meaning the benefits are likely going to just vanish once those funds run out. So the big takeaway for us here is that we really shouldn't expect a temporary stimulus to magically change home builder behavior or suddenly build millions of houses overnight. Which brings us to part two, the root cause of all this madness, housing supply. Let's take a look back at inventory. Because here's the cold hard truth. Cheaper financing doesn't actually solve our fundamental problem. And that problem is, we simply do not have enough houses, period. Giving a buyer cheaper financing just gives them a temporary way to pay a higher price for the exact same limited number of homes. It's kind of like a game of musical chairs. You've got the ghost of the 2006 crash where builders went into absolute overdrive and then just completely stopped, creating a massive deficit. Then you combine that with 2020. Everyone refinanced into these rock-bottom rates, creating this incredible lock-in effect. Think about it, if those owners sell now, their monthly payments could literally jump by 50%, so they're frozen in place. But things are finally starting to shift. Tracking toward the end of 2025, sellers are actually projected to outnumber buyers by a record 530,000. Moving right along to part three, the affordability crisis explained and the literal math behind the madness. This lack of supply has completely and totally broken the math of home affordability. Just look at these numbers. Back in the year 2000, a median home was about $120,000. You only needed 1.7 times the median household income to buy it. Even at the absolute craziest peak of the 2006 bubble, that ratio hit 6.8 times. But today, looking toward 2026, we are sitting at an all-time high ratio of 7 times the median income. 7. We've actually reached a point where buyers over the age of 70 outnumber those under 35, simply because younger generations are completely priced out. The relationship between what we earn and what homes cost has literally never been this strained. To put this in stark, real-world terms, the income you need to buy a median home today is exactly double what it was just a few short years ago in 2020. An income of $55,000 used to safely secure a home. Today, you're looking at needing $110,000 a year for that exact same house. Now, let me ask you, has your salary doubled in the last 4 years? For the vast majority of us, the answer is a hard no. And remember, that's before we even start talking about basic ownership costs, things like property taxes and insurance, which are absolutely skyrocketing right now. So that leads perfectly into part 4, 2026 expert forecasts. Will home prices actually drop? With all these wild dynamics going on, you'd probably assume prices have to crash, right? Well, the experts actually disagree. Despite the affordability crunch, that short-term boost in buyer demand from lower interest rates is probably just going to let buyers pay slightly more for the exact same homes. Redfin is projecting a 1% gain, Zillow expects 1.2%, and Realtor.com is actually forecasting a 2.2% increase nationally. Basically, as rates fall, the monthly payment theoretically gets cheaper, so a buyer can suddenly bid just a little bit higher while keeping their monthly budget exactly the same. The result? Prices just rise until the monthly payment hits a brand new equilibrium.
But guys, here's the massive aha moment. Even though all these analysts expect home prices to go up in 2026, those predictions are actually negative once you account for inflation. This is a really critical concept to wrap our heads around. If your home goes up 2% on paper, but the broader inflation rate in the economy is 3%, your true purchasing power actually went backward by 1%. So the general consensus for 2026 is that yes, home prices will go up in terms of nominal dollars, but their actual real-world value relative to inflation is likely going to decline.
And that brings us to our final section, Part 5, the new rules of real estate, and exactly why the old playbook is dead. This shrinking real return completely explains why longtime real estate investors are actively, right now, rethinking their entire portfolios. I mean, a decade ago, you could buy almost anywhere and come out on top, but today, stagnant equity returns are just being entirely eaten alive by skyrocketing overhead. Imagine having equity that's only earning a 4.5% return compared to the 12% we were seeing years ago. Honestly, you could make that in a risk-free savings account right now, and you wouldn't have to deal with insurance rates that have doubled, water bills that are up 50%, or maintenance costs that are just completely out of control. Plus, in places like Los Angeles, local rent control limits rent increases to just 90% of the consumer price index. At that point, as an investor, you mathematically cannot even keep pace with inflation.
And this quote right here brilliantly summarizes our core takeaway for today. You simply cannot confuse past performance with future results. The rules have fundamentally changed. Buying real estate is just no longer an automatic win. It requires doing the hard, granular math on renting versus buying, and really understanding that you have significantly less room for error today than you did even 5 years ago.
So as we wrap up this explainer, I want to leave you with this final thought. When we're facing a 7 times price-to-income ratio, all these artificial market interventions, and shrinking real returns, are you still relying on yesterday's old playbook to navigate tomorrow's market? Thank you so much for joining me to unpack all this data, and I'll see you in the next explainer.